right. Good afternoon. Good morning to everyone tuning in, depending on where you are in the country or where you are in the world. It is a great day. It's Valentine's Day. Bitcoin is way up. So this is a great day for Adil and I to talk about Bitcoin and crypto and where we think the market is going for investors, for you if you're an investor, for you if you're an advisor, an asset manager, or wherever you are in the crypto or TradFi space. Glad to have you here. I'm here with Adil Abdulali from Samara Alpha. And we're going to have a great discussion. But first, of course, we have to have our disclaimer up, which we would like for everyone to be reading. And as you're reading that, I'll tell you a little bit about what Adil and I are going to discuss. We're going to talk about our introduction, how we got into Bitcoin and crypto, and where we've seen the investment theses go from when we started to where we are now. We'll talk a little bit about some of the investment theses we see on the horizon, both positive and negative, what could go right, what could go wrong, and what we're hearing from investors, what they're thinking, some of the alternate metrics that they're looking at that are only there for crypto, that are not necessarily metrics we've seen in the traditional finance world. And we want to let you know, everyone tuning in, if you have questions, go ahead and write them in the chat. We're going to try to get to them in roughly the last 10 minutes. But as you're thinking, as you're thinking of those, go ahead and put those in the chat so that we can make sure that we're addressing the ones we need to address later. And if we don't get to your question, we apologize, but we'll try to hit you up afterwards with either a message or something to address if your question is pertinent to something we're discussing today. So, without further ado, I'm going to introduce or allow Adil to introduce yourself. Adil Abdulali from Samara Alpha. Go ahead and tell us a little bit about yourself, Adil, and then I will jump in and talk about me and my journey to get here in crypto.
Great. Thank you, Adam. So my start in all this finance stuff started in the 90s on Wall Street in mortgage derivatives, off-balance sheet swaps, credit derivatives, and all kinds of fun stuff. That was, leading into the year 2000. Then I ran a hedge fund for a bunch of years in mortgages and asset-backed securities, and then started investing in hedge funds directly in 2003 out of a platform called Protege Partners. Protege Partners was a hedge fund seeding platform, and we ran portfolios of hedge funds for endowments, foundations, high net worth individuals. And at that point, of course, crypto hadn't been invented and I was not involved at all. But in 2010 or 11, our chief technology officer went up to the drawing board one day, this was 2010, and wrote all this stuff out about Bitcoin. And we were all very skeptical. I was like, this is insane. We didn't take it seriously, but it was kind of a fun idea. So we all bought some in some weird way, like sending money overseas and getting little chits of paper from the corner deli store. And, it was like $10, $20. It went up to 100. A lot of us sold it to each other in various weird ways. But then we forgot about it. I did not take it seriously at all. In 2015 at Protege in our seeding business, we accidentally, got introduced to the MIT's involvement in crypto. They ended up starting the digital currency initiative, and we put some of our partner capital to support that venture. They were really positive on the Bitcoin protocol and the technology. And so we started to take it seriously. We got introduced to some early founders in the space. We ended up day $1 in various hedge funds. They were really not hedge funds in those days, but like speculative plays on this technology. And we'll go more into that in the future. But long story short, 2019, when the hedge fund seeding platform Protege shut down, I was too involved in crypto to go back to long short equity and credit or anything that boring. So I stayed in crypto, started a asset manager that focuses on crypto, and that's how I got here.
All right. So you have that background in kind of traditional finance and funds and stuff, and then you got to see where crypto came in. And I think importantly, Adil, for this discussion is the thinking of, as I've seen, and I'll go to my background in a moment, the thinking of where are there inefficiencies, where is there room for Bitcoin, and where is there room for crypto in the financial system and inside a portfolio. And I think coming from where you come from, I think that's a kind of unique experience and unique perspective. So I look forward to getting into that a little bit more. A little bit on my background is I was in probably my second or third career, was a financial advisor for over a decade, had my own RIA, had my own registered investment advisor with a business partner. And it was about 2017. He had been talking about Bitcoin and talking about it. And finally, I was the typical financial advisor that said, I don't believe in that. It's fake money, all of those things that you usually hear from financial advisors, from basically anyone in the financial services space. And finally, he convinced me, he said, just go buy some. And I said, I don't even know how. I don't know what you're talking about. I had to go to this weird thing called Coinbase at the time and go through all my KYC AML. And the first thing I bought was ETH, because ETH was $200 and Bitcoin was 5,000. And surely the thing that was worth 200 was going to eventually be worth 5,000. So I thought I was the smartest investor in the room. And it went up. Then I bought some Litecoin and it went up. And that's what kind of sent me down my journey until my business partner said, did you know there are thousands of these things? And I said, I got to understand why. And that's what really sent me down the rabbit hole of understanding things like understanding blockchain technology. And that got me excited, thinking about the idea of like home titles, real estate titles, ownership of things like cars and assets. That's what got me excited about blockchain technology. Then in 2019, we started a YouTube channel just to explain it, not to try to get anyone to invest, just to explain it. 2020, we sold our RIA to focus on actually teaching crypto, Bitcoin, blockchain, wallets, custody, all of that to financial advisors, with the idea that a lot of people, that there's going to be more adoption and more investment in the space and in these assets if financial advisors understand it. So that's where we are today. My company called Interaxis is focused on education and helping financial advisors understand crypto, how to make it part of their practice, and on helping crypto-related companies understand how to get to the financial advisor market to try to get their products or try to get their investments in the hands of investors. So that's a little bit about where I am and where I've come from to get to today, getting to talk to you, Adil.
Fantastic. Like when you talk about Bitcoin, and the whole title of this is Bit by Bitcoin, like, how did we all get into Bitcoin? But, as I learn more and more, like you, I try and teach people about it, but I realize I don't quite understand it ever because it's a very, very new technology. So I think we all have to keep an open mind and be open to different interpretations of it. Like even Bitcoin by itself, like when it started, it was very much, okay, let's use this as money, right? And the money part of it for transactions was one piece of the puzzle, which was the first piece, was, okay, let's buy pizzas with it or what have you. And that really didn't last very long because it's very hard to transact in Bitcoin or what have you. And that narrative has changed, but the technology really hasn't changed that much. And so the narrative now and the use case is more store of value with respect to Bitcoin. So my point is it's evolving, and the way that it will be used in the future, I think, is very unknown. And we just have to keep a very open mind and roll with it. I don't know if your experience is that what I first thought about Bitcoin and what I think of it now is quite different, but it's still very, very attractive. And you can still do a lot of things with it. And it's growing all the time.
Right. You're right. The early days of Bitcoin being so decentralized, it was very much an experiment, right? Those that were early adopters, including you, as you said, you were just kind of trading it around. It was very experimental. Oh, look how cool it is that we can buy pizzas and we can trade it to each other, and it's worth $1 or $2 or $5 or $10. What we've seen is those that have obviously become tremendously wealthy because they've owned Bitcoin or held Bitcoin or been Bitcoin miners or something. It's because they've had a tremendous amount of conviction in something that in the early days had, honestly had very little reason for someone to have that level of conviction. And it was seen as kind of on the outskirts and not something that played with traditional finance, played with traditional financial management or portfolios. And so it's really interesting. I think, again, Adil, your perspective of where it was when you were in your, earlier hedge fund days to, in those investment theses, again, which was relatively speculative, which is relatively experimental. How much fun are we having with this thing? Bitcoin pizza, of course, the negative correlation with something like Silk Road, to today, where now we're post ETF approval in the US. Can you go a little bit into how it was looked at in the past, in the, I guess, distant Bitcoin past, which is kind of relative for everybody, right? The distant Bitcoin past, the recent Bitcoin past, and how you're looking at it as an investment for the future based on ETFs, based on institutional adoption and investment, based on what might be happening in terms of DeFi on top of Bitcoin, and kind of the growth of crypto. Can you talk about where it was versus where it's going in terms of the investment theses you see?
Yeah. So, if you think back to when we got involved in 2015, it was still very niche, and we were not going to put any real investor dollars, third-party money into it at all. That's why our initial forays was with our own capital, because it was very experimental. It did not have legitimacy in any way, shape, or form at that time. It was much more of a toy. And it continued to get a lot of kind of negative attention, because of the Silk Road, the drug trafficking, this and that, the idea that it could be used for like nefarious purposes, notwithstanding that the US dollar is used for more nefarious purposes than anything else. But, the use case was sort of like out there. The use case, especially for people in the West who have good banking, who have US dollar accounts that they can open without a problem, was kind of mysterious. It really was only speculation. Like, can I buy something, goes up a lot, and then I cash out and make something? It really was not there to save money or to save taxes or to save your savings from the government seizing it, which was the case in the rest of the world. So even back then, when here in the West, we were sort of playing with it, people out there in the, emerging markets in India, in Venezuela, in Latin America, they quickly saw that, oh my God, I can put this thing into Bitcoin. And then eventually now more and more stable coins. I mean, stable coins, we'll get into that, but the idea of somebody in a foreign country who has no access to US banking can effectively open a US dollar account. This is afforded by this technology. And this is the here and now use case, which is not clear to us in the West, very clear out there in the world. So as the use cases and more people globally started to adopt it, at the West, in the US, the regulators and all were still thinking of it as like, okay, we can ignore this or squash it or get rid of it, because in fact, in the West, the only use that they saw, not having interacted with it, not having used it, not thinking about it, was that, oh, it's used for criminals. And that is absolutely not true at all. It's like a tiny, tiny fraction, a way less fraction of crypto and Bitcoin is used for that than dollars. Dollars is the main currency of criminals all over the world. It is a true anonymous money. Then the ETF thing, how does that play into this? Yes, the ETF sort of story of being approved has been in the making for 10 years. And the fact that it wasn't approved was a big cloud over the space, because it lacked legitimacy. Because if the most legitimate type of investment thing is rejecting Bitcoin and rejecting crypto, and people are not allowing it to happen, then it must mean that there's something very shady going on. Well, that actually has changed, which is fantastic. So more than just the flows of money into the ETFs, and therefore, on the margin, there's going to be more crypto bought in the long term. The main thing for institutional investors that we see talking to people is that the conversations, even till the end of last year, 2023, versus now, the post-approval era, there's nothing that is so, they're not questioning, about custody and all of this nonsense that was there before. It all kind of works out because, BlackRock and Fidelity and all the big boys have looked at it. They've played with it. They've starting to put their investors in it. And so therefore, we have a lot better chance of having good conversations with investors, not having to fight like yesterday's battles. But this is going forward and looking what can it do? We talk a lot more about the use case of, Bitcoin, the things being built on it, fun things like NFTs and the ordinals and all kinds of stuff, which not just saying, oh my God, regulation. I mean, last year was all about that. We're not talking about that anymore, which is fantastic.
So going back, from my experience, I think it's important to note, as you said, early days, it was pretty experimental. It was, trading money back and forth. And there was some thought, there was some idea behind this Austrian economics, the verifiably scarce supply. But a lot of that was actually theoretical, right? We hadn't had inflation in the U.S. in like 15 years, and people, elsewhere in the world weren't necessarily utilizing Bitcoin. But I think what was important in the early on days was, believe it or not, I think the idea of something like Silk Road was actually really important to Bitcoin because it actually showed the use case. And yes, we don't want the use case to be criminal activity, but I use the analogy of the internet quite often. And the early days of the internet was really grew because of gambling and porn, right? That really pushed the internet industry and the internet technology forward a little bit. So if we look at Bitcoin, those that really needed to use something to transact financially without going through banking systems, honestly, were either people in other countries who didn't have access to banking systems or criminals who couldn't use the banking system. Now, what we've seen is the progression to more and more people all over the world utilizing Bitcoin, the asset as a store of value, and using Bitcoin, the network, to move assets, to move something of value around the world at a much faster pace and for a much lower cost than they could do utilizing the current financial system. So, as you said, we in the U.S. hadn't seen the need for it, and most of the investment thesis behind it was very theoretical until, lo and behold, we saw many people elsewhere in the world starting to utilize Bitcoin or starting to utilize crypto. Countries like Turkey, Argentina, other places in the Middle East, other places in Africa where people couldn't necessarily trust the value of their currency, nor could they trust their banks. They started moving towards Bitcoin. And then we saw inflation start happening in the US for the first time in who knows how long. And some of those investment theses actually started to play out. Some of the ideas that, okay, if we keep printing money, we're going to get inflation. If we keep printing money, we're going to get inflation. And then we got inflation finally. And those of us, or those that had been, on this Bitcoin kick for a while, were going, we told you this was coming. We kind of knew this was coming. Everyone just said status quo is fine. And we're the ones saying you're going to need some sort of asset to hold in your portfolio such that when there is inflation, you maintain your purchasing power. And that doesn't just go for elsewhere in the world. It started to go for us in the US. And that was leading up to the ETF. Now that we have the ETF, I think any of us who understand Bitcoin and the verifiably scarce supply knows that the ETFs are materially contributing to the demand for Bitcoin, which is the price, but also that, as you said, it's the SEC kind of giving their stamp of approval and adding this validity to it that's opening up this institutional wave of companies and individuals, wealthy people, not wealthy people, people in their investment accounts going, all right, I want some sort of exposure.
Yeah, I mean, I'd like to comment on a couple of those points that you made, especially about, people using this technology to send value to each other, which perhaps is not sanctioned by the powers that be, and you really, it's not just the nefarious stuff that you mentioned, but, I firmly believe, if you look at history, that, one man's terrorist is another man's freedom fighter. And then, the winners get to write the history books. And along the way, how does financing happen for these groups that could be fighting for human rights, fighting for freedom under some very authoritative regime that controls the money system with fiat currency in that system? So whether it is, somewhere, I mean, God, truckers in Canada, that's Western world. And the only way that they could actually get some value was through the internet and Bitcoin, because the banking system was shut off for them. I'm not taking sides on any of this stuff, but all I'm saying is that there are many, many cases where there are people who are subjugated, who do not have individual rights, who need to get support from the outside world. And here's a technology that value can be transferred. And there's nothing nefarious about that, other than from the standpoint of the authoritarian regimes who wants to squash all types of dissent on that. So it's a very, very useful technology for that reason. And it's the first time in human history that we've had some way to transfer money or value. I don't even want to say money. Money is just one use case, but value peer-to-peer so that nobody can stop it, right? It's transparent. You can see wallet value going from one place to the other, but you can't be censored unless you actually shut down the internet itself. which we'll get to as one of the risk factors later.
Right. Exactly. So let's talk real quickly, Adil, going again from when you started understanding Bitcoin and possibly even when you started, managing crypto assets. We see so many people that have, made those tremendous gains, right? Started with virtually nothing or started mining Bitcoin on a home computer. And here they are worth 8, 9, 10 figures worth of crypto. Now, from here on out, it's much less likely that you're going to see those, ability to go 100x or 1,000x or 10,000x on your Bitcoin. So we kind of know where the investment thesis was before, or where the investment went before. Again, it was very speculative. It was people who were kind of libertarian or really looking into that and really not into whatever the status quo of the financial system was. From here on out, where do you see the Bitcoin in a portfolio? Who do you see allocating to it, and where do you see in a portfolio kind of how much, what type of allocation, what do you see the risk for it, and where do you see clients allocating to Bitcoin?
So the main, I think, difference is that before, as you say, it was sort of a yo, like, put something in and, it's just going to go maybe whatever. It's a complete speculative thing. I think now the view is much more, okay, it's a technology that's here to stay. And how do I think about it? Like, do I want to be part of this surge of technology or do I not? And if I want to be part of it, what do I pick? Like, which coins? Because it's more than Bitcoin, right? Bitcoin is certainly the granddaddy. It will always be around. And it's sort of the precursor of the thing that opened up the box to, like, this is a possibility of transferring value. And now you can do all kinds of things. So, currently it's like how much of your portfolio is in it is really about, what do you think about how the internet, as you pointed out, evolved? Like in the early days, when there was email and there was these like little, companies like .coms that were, who knows what they were doing. You could have thrown darts, and as long as you picked one winner, you could have had 100 losers. And, you got things like Facebook and Amazon and Google. I mean, Google sounded very silly when it came out, right? Google, I thought, well, what a silly name for a company. And now Google is a very respected name. You don't know which one of these coins or protocols is going to be used in that type of way with a new business model, which we cannot even remotely imagine right now. So the story that I'm talking to investors about and what I hear back from them is that they're starting to believe that, okay, well, if this is another real wave and this technology is going to permeate everything, because as you know, like in the beginning of the internet, there were internet companies and non-internet companies. Now every company has an internet presence. Like there's no company that does not have something to do with the internet in some part of their business. And that's going to be crypto and blockchain, because that way of transacting value is going to permeate into every type of business. So instead of being like, a crypto business or whatever, it's going to have some blockchain crypto rails around it no matter what. And so investors are starting to say, okay, well, if that's the case, then we have to get involved, right? Let's put some money in various different things. Ideally, if they're adventurous, they try and do it themselves. If they're not adventurous and they want some cover your ass, then there are many good fund managers. And that's an amazing thing too. This industry has the brightest and the best coming into it. The young intensity that is coming into this industry at the protocol level, at the level of programmers, I mean, millions of people. There are so many, as you say, yes, there's so many coins, but there's so many people coming up with good ideas to program, with new ways of doing things. There's a lot of infrastructure to be built. They're all building it. They're all excited by it. We have people that we can hire now, and we have hired, who could get jobs at any good, fantastic company, but they want to be in crypto, and they see it, that it's like exciting, it's fun, and it's growing. Like they can contribute so much because there's so much to be built, which is fantastic. So you're the best minds coming into it, an asset class that's growing, valuations that's growing, legitimacy that's growing, and still only a couple 100 million people are involved out of the 8 billion that are around. So there's a lot of growth ahead for this.
Right. One thing that I tell our students quite often is, or I've gotten asked this question, what's crypto going to look like in 10 years? And I said, it's not going to look like crypto. It's going to be called the financial system. That's just how we're going to go. And one of the reasons I say that is because we always evolve forward. And this is not a revolution. It's just an evolution. It's just a natural way that we went from telegraph to telephone to fax to internet to now to crypto. It's just a natural evolution. And you, whether you're an asset manager, whether you're an investor, whatever it is, it just will behoove you to learn about it, because it's going to change your idea of how we look at valuation, change your idea of what investments look like, what kind of metrics we use. So again, you and I can probably expound on this all day and enjoy it. We're our own little echo chamber, and probably a lot of the people on here are, part of that echo chamber. But I want to make sure that I'm able to ask you some questions, Adil, that'll help people in here, so that you and I don't just fanboy out on crypto all day. So I want to ask you this: what will happen? What do you see happening in whether it's just Bitcoin or crypto now, in the next year and in the next 5 years, that's going to have a significant, or can have a significant effect on the value in the investment? And that can be to the positive and to the negative. I want to go both directions. What do you see happening, or what do you think might happen that will take us positive and negative in terms of the value of crypto assets?
So let me start with the negative, because then I want to end with the positive, of course. Fundamentally, this is a piece of technology and a bunch of different pieces of technology and software. It's software that lives on a base of the internet. So the internet is a vulnerability. Like, there are places in the world where the internet is controlled. There are places in the world where it can be shut down. There's core infrastructure that is very necessary for, at the moment, crypto, blockchain, Bitcoin, just to exist. Because if the internet wasn't there, it would not exist. So that's at the fundamental level. Now, there are some, decentralized internet type infrastructure that's being set up, where the points of vulnerability are distributed, and that's kind of in the spirit of crypto, and maybe eventually that'll be the case, but that is absolutely not the case now, and not about to happen anytime soon. So in the short term, that's definitely a risk. And then the software have bugs, and bugs can show up with an upgrade, and things have to be upgraded, including the Bitcoin protocol. People go on and on about the Bitcoin protocol being unchangeable, unchanged, whatever. But the actual software, the code, has been upgraded several different times and will continue to be upgraded because new things will come about. For example, when quantum computing comes about, the cryptography part of it, which is just like the wallets and how they store the private keys and all of that, will have to change. So that'll have to change some part of the software to make that easier. And again, it's an amazing thing with this crypto assets and these communities, because the way every crypto asset like Ethereum or Bitcoin is a way to coordinate a whole bunch of people that use the protocol to do things together, where no centralized party is deciding what should happen with the software, but these people are somehow deciding when to do it, the community of miners and nodes and users and everything else. And it all happens. It's happened with Ethereum, it's happened with Bitcoin. But when there's an upgrade like that, there's a chance of a bug, and there's no getting around it. Software, it's got millions of lines of code, and it can go wrong. And if something goes wrong with that, especially one of the large assets, it is going to really shake people's confidence in the system, and it'll set us back, I think, several years if and when that happens. Hopefully, it won't happen. There are enough test nets and what have you. So that's really one of the risks. I'm not even going to go into all the regulatory and political part, because that's been sort of hashed over a billion times, and it's going in the right direction over the long term. The benefits, of course, are like, it has opened up a whole new way of looking to organize people. I mean, essentially, human beings definitely survive and thrive because they do things in groups. We all know as individual people, we are powerless. Most creatures can eat us up, but we can, definitely win the battle with numbers and coordination. We've coordinated around narratives, around religion, around country, around movie stars, all kinds of cultural things allow us to coordinate together. And now we can coordinate economically with incentives done by tokens on these networks. So a different way of coordination of large groups of people which have all the same motivation or all the same goals in mind, whether it's file storage, whether it's having a decentralized cell infrastructure, whether it's sending money to each other in a community that no other people outside the community can stop happening. That's what this is. So I think the exciting part and the things that's going to grow it exponentially is suddenly when one of these things starts to really work. So like what's already working in stablecoins, right? I mean, stablecoins, I don't know if people know, there's like more than $11 trillion worth of settlements on stablecoins last year. That is more than what Visa settled on their SWIFT networks, right? And it was done all over the world globally where, you didn't have to have a banking infrastructure or anything. All you needed was an internet connection and open a wallet, a Tether wallet or a USDC wallet. And now you're good to go. You have a bank account. You can put quote unquote a bank account. You can own dollars now, even without anybody being able to stop you. So that stablecoin use case is done. It's fantastic. What if the cell network gets built with helium, like you and I talked about recently? Maybe you should touch a little bit on your helium story. I found that very, very interesting because that is, one of those technologies that's purely possible because of cryptography and because of blockchain technology. A lot of people don't even know it exists.
Yeah, well, something that you and I talked a little bit about yesterday, and I'll definitely get into the helium story, but something that you just discussed, which is stablecoins, and I think what many people in the financial services world don't understand is you go, okay, you're just transacting in something that's worth $1. How does that impact the value of something like Bitcoin, the value of something like ETH? And that's where as we start to understand where the valuation of crypto assets comes from, you get to know, okay, if most of these stable coins are moving around on the Ethereum network, then there will be more demand for ETH, the native cryptocurrency of the Ethereum network, to actually make those transactions run. So as there are more and more billions of dollars worth of transactions in stable coins, even though the value of the stable coin should theoretically remain $1 or a euro or whatever it's pegged to, that still theoretically increases the value of ETH because you have more and more transactions. You have to pay for space on those blockchains. And therefore, if you're a asset manager, if you're an analyst, whatever it might be, you have to understand where the value of ETH potentially comes from. And that's demand for space on the Ethereum blockchain. More stablecoin transactions equals more demand for space on that chain. And that's where you alluded to early on the need or the understanding of different and new metrics within the blockchain ecosystem that we're just starting to learn and figure out and understand. And quite honestly, a lot of them is just theory as to how they should impact the price. Things like Bitcoin wallets that haven't moved any Bitcoin in the last year or something. Where does that play into the value of Bitcoin or predicting the value of Bitcoin based on certain moves? Where does the value of the number of stablecoin transactions predict? We look at new valuation metrics like number of developers developing on a particular network and what that means for the value of those assets. So moving forward, it's not just figuring out what to invest in, but figuring out how we're going to try to value some of these assets that are not equities, they're not debt, they don't necessarily have a claim on any sort of assets. However, there is some value to them. How are we going to figure that out? And maybe that's something that you're thinking through and working on.
Yeah, and just Bitcoin itself, right? Where does it get its value? We talked about, currency, day-to-day transactions, maybe that not so much. Storage of value, maybe some amount. But in the end, it's a network of people, and how much is the network used is going to drive the value of the collective. And in Bitcoin, one of the risk factors, which I didn't mention, was that, part of what keeps the Bitcoin network running is the fact that there are miners who get paid in Bitcoin, which has some value. So it's a virtuous circle. The more Bitcoin you mine, you get paid in Bitcoin for doing that mining. but the amount that you get paid for mining a certain amount, for using a certain amount of energy to mine, is dwindling, right? That's where the halving comes in, and you get fewer and fewer Bitcoin rewards for making every block. Eventually, this will be de minimis, and the theory is that by that time, there would be enough transaction volume that charge fees in Bitcoin, so you'd be earning in fees what you're not getting in mining rewards. But, for the past 2 years, that's been a theory that's, it's not quite working out. The Bitcoin network was being used less and less. More people were using it just to store value and not do anything. And so transaction fees were very, very low compared to some of these other networks. And there was a real fear that, if you don't do something more with Bitcoin than just store it, it's gonna fall apart eventually. And then, of course, with human ingenuity, they came out with this ordinal thing. And what's the ordinal thing? The ordinal thing is just a way to store stuff on the Bitcoin blockchain, pictures, JPEGs, whatever. So the old sort of mania of NFTs that mainly happened on Ethereum a year and a half ago suddenly came to Bitcoin, and suddenly you could have your picture or JPEG or some fun thing that you could write into the Bitcoin network, and it would be preserved forever in this thing. And suddenly the mempool, or what they call the transaction, volume in Bitcoin exploded. The fees on Bitcoin actually was higher than Ethereum for a while. And suddenly the ordinal way of looking at things, or just this way of using technology in this ingenious way, has opened up a whole host of potential development in Bitcoin. So Bitcoin, which was left for dead as far as development went and developers, suddenly it's got more funding from developers, more new things being built on it. And that's going to lead to more value for Bitcoin. So, one of the things that drives up is usage of the networks. And I'm very, very happy that Bitcoin usage is increasing. I'm not a purist from that sense at all. I think these things are there to be used. The more they get used, the more the networks will grow, the more the value will grow. And one killer app is all you need to really drive things forward.
Exactly. And I'm with you in that for a while it was people held Bitcoin to hold Bitcoin. And the more people that just hold it, and the more, ultra high net worth people, the more Michael Saylors there are, the more ETFs there are, you're going to have you're going to have less and less actual usage of the network, and just a whole bunch of people holding the token and like 3 people moving it around. And then what's the point of all those miners that are paying millions and millions of dollars per year in energy costs, moving around a few tokens? But what you said, ordinals kind of launched something that people said, oh, there's potentially more to Bitcoin. Let's get the smart people together and figure out how we're going to build a financial system on top of the safest, most secure network we've ever seen, and actually put some usage behind not only those tokens, but the actual network, and create this settlement layer. And so just in the last few weeks, I've seen, someone trying to launch a ZK related layer 2 on top of Bitcoin. I saw where a company called Portal raised like $34 million to build a decentralized exchange for Bitcoin. So seeing the use cases, and as I alluded to earlier, going back to the days of the internet, going back to the idea of evolution, the smart people are going to see what's there, and the market's going to do what the market does. Meaning it's going to take this technology where it needs to go and where the market wants it to go. And eventually, if the market says, look, we don't want to do this on Bitcoin, we want to do it on some other network, that's where it's going to go. And no amount of anyone screaming and crying and going, no, Bitcoin is the safest, is going to help. The more people want to transact on that network, the more is going to be built, the more adoption there's going to be. And then there's going to be more use cases for it. So when you have countries, right, like El Salvador and Argentina that are starting to tear down their central bank and starting to look more at something like Bitcoin or decentralized ledgers or digital currencies to help stabilize, then you're going to see more real adoption, right? This is not going to be degen activity. It's not going to be the people that were willing to experiment early on. It's going to be people doing it out of actual need. And that's what's going to drive the real use cases, which, as you said, if you understand the metrics and understand all that, it drives actual value of Bitcoin. And it will, same thing for Ethereum, same thing for Avalanche, same thing for Solana. The actual use cases are what's going to drive the value. And at this point, we're at the stage where we just have to kind of understand the technology to theorize on what that means for the value of those assets.
Yeah, and I think the killer app is going to be something that's facilitated by the user interface, because the user interface for all these networks, including Bitcoin and Ethereum and all that, is very rudimentary. Like, you have to do all kinds of crazy things to transact in this stuff. And so once that's wrapped into a user interface, which looks very simple, and you don't really know what's going on at the tail under the hood, that's when the usage will explode. Just like, when the browser was invented for the internet, I love this analogy because it works so well. Is that before the browser, there wasn't large adoption of the internet at all. But the browser make interaction with that transaction layer of information, because the internet is like an information transaction device, just like the crypto rails are like a value transaction layer. That browser made it easy, and so then it exploded. In crypto, that browser type thing isn't there yet. Now, there are real companies like Visa playing around with that. Like Visa actually also uses, I believe it's the Solana network and stablecoins on Solana to settle some value of theirs, because they figure, okay, well, here's a 24/7 network that I can do small transactions for small fees, and I don't have to have relationships with all kinds of banks in the particular jurisdiction and have like on-ramps and off-ramps to their fiat system, and we can just do a Visa card in XYZ location and transfer value. So they're actually using it. Now, once you can use your Visa card, you use your Visa card. You don't know if under the hood they're using the banking system and Swift, or they're using Ethereum or Solana or something like that to move value around their various ledgers. And if that happens, then it gets huge uses, right? And those gas fees that will generate will be a lot, because people use Visa a lot and they use MasterCard a lot. And so, that's, I think, one way to solve the UI problem is to use an old world user interface, which is a physical card. But then as soon as you use it, instead of that message going to a regular bank, going to the bank of the merchant bank, your bank, changing their little ledger entry, it just gets changed in the piece of software called a crypto network.
So it seems like we've gone from experimental and speculative, right? This idea of this might work, but let's see if it does, and let's see if it gets adoption, and let's see if people actually respect it, and the networks can keep going and all that. So we've gotten to that point, right? We have at least Bitcoin and Ethereum and some others that have continued to move the network forward and continue to do that using only honestly a completely made up currency, a made up asset as the incentive system to mine or validate blocks. So we've gotten to that point. We now have, we obviously now have some institutional validation. From here on out, as you and I have talked about, what we see is this building and growth, this increase, this probable increase in actual adoption and beyond speculation of actual investment, and most importantly, actual use cases. So when you're talking to investors, what are they saying? What are they thinking about crypto? How are they thinking about allocating to it? Is it a large percent, a small percent? What are they thinking in terms of the risk they're making when they allocate some of their assets or some of their portfolio to Bitcoin and to crypto?
It's still a small percentage, in the greater scheme of things. So, call it 1 to 5%, 5% being on the very, very high side and 1% being quite acceptable. But, 3 years ago, it was like 10 basis points. It was like something that you would never have to tell your investment committee about ever, right? But I would say on the investment committee front, it's still predominantly investors who don't have an investor committee. Like if you have to go to a committee, it's still a little bit kind of, you have to stretch it and you have to convince them and all of that stuff. And yes, there are institutions that are involved, but they're just getting involved. And it's going to be a small percentage of the allocation. I think, that's absolutely fine, because so few people are involved that if everybody gets involved and it's even a tiny percentage, that's going to drive the next phase of growth quite handily. So, they're still very skeptical as far as, the value goes. And it goes with the markets. Like, it's funny, every time there's a bear market, and there's been so many of them, people say, oh, blockchain, I like blockchain, I don't like crypto. And then when the prices go up, oh, I like crypto, it's all crypto. I want to say like this crypto blockchain dichotomy is, in my mind, at least it's a false one. I mean, crypto, blockchain, blockchains existed for many, many decades. Cryptography existed for many, many decades. It was the interesting pairing of the two in this sort of incentive scheme mediated by tokens and putting it all together that made it very useful and kind of a new way of looking at things and a new way to put things together to do interesting things. So I think people are just realizing that and they're coming to grips with that and saying, okay, well, we don't really know what's going to happen, but we don't want to miss out. So they're not missing out, not from just the price going up, but from the technology doing useful things. That's just about happening right now. And it's just about happening because of the real use cases. So it's, this is the chicken and egg thing, right? But any technology comes out, it's crazy, you don't know what it's for. Then you have a little bit of a use case, it starts using it, people see it, maybe there's something there, more people come in. I think we're just at this phase of accelerating to the use case growth rather than just the price going up growth. I wouldn't be surprised if this current bull market in prices will also, a lot of the use cases have been built in this last bear market of 2 years or so. I think a lot of that will come online and it'll open people's eyes, and it's starting to.
Do you think a lot of the investors you speak with, do you think they're getting over either the I guess headlines of hacks and exploits within kind of the DeFi protocol space, and bigger than that, of course, the likes of Celsius, Voyager, and FTX? Do you think they're to the point where they're kind of getting over that, and we can talk them through, here's why investing in it is safe, here's why when you invest through me or through my fund that you're not investing in FTX, that we're not taking your money and doing something else? Do you think they're getting to the point where they're getting over some of that and willing to go, all right, we realize that those were just bad actors, and the technology and the asset class is still viable, and in every asset class and every technology in every industry there's just going to be bad actors? It just so happens that this was really big.
I think that if you point out the facts to them, like FTX, for example, was the biggest exchange at that time in the US, and it was also the most respected one, and kind of the thing that was supposed to be above board, and it went under overnight. Now, any diversified portfolio, and I've talked to many portfolio managers who were involved with multi-strategy funds, fund of funds, whatever, and if you were investing in a whole bunch of things, maybe FTX went under, you lost 10%, right? On average, these multiple lost 10%. But pools of those assets are making 30, 40% a year. So is that a death knell? No, you take your cuts and you move on. So diversification helped a lot with FTX, and anyone who had that point of view came out of it fine. And people who are looking at the result are saying, oh, okay, so this is just like every other asset class. Don't put all your eggs in one stock or one thing, unless you own that company or the CEO, then diversification is not good. But other than that, diversify across different assets, different venues, different counterparties. And there are going to be bad actors. You can never foretell what's going to be fraudulent. That's one thing I learned in my investment career. Like the people who look fantastic end up being like rotten in the inside. You just don't know. The whole point is the unknown unknowns. You will not be able to predict. And the only salvation is diversification. So when things go wrong, not if, because they will, when they go wrong, you're not overly hurt by it. So, you run a diversified portfolio in something as volatile and interesting as crypto and blockchain, you'll be fine, because all of it is not going to disappear at once. So that's key. And once you explain to them, you can show them portfolios, how they've reacted, real track records, how they've reacted to these really bad events, and the fact that they come back, right? The prices come back, players get improved, regulations get improved, infrastructure gets improved. I mean, the whole counterparty risk 4 years ago, actually, it was really hard to not have a huge amount of risk from any bankruptcy in the space, because everything was like, facing a counterparty. There was very little way of having like a third party custodian or something looking care of your assets. and then just doing the trading on a different venue, like it is with traditional assets, where you only risk the stuff that you're using, not the stuff that you're just storing. That just didn't exist. Now it exists a lot. There are all kinds of solutions where you can put your crypto assets in a third-party custodian. Then there's tri-party agreements, netting agreements. All of the things that make traditional finance safer are being put into place in crypto as well. And you have this additional pro where a lot of things are very transparent with crypto. So once you understand that, like if you have an administrator in a bunch of funds that's administrating crypto, in traditional assets, there's a lot of dependency on people sending you information, either online in files, FTP, whatever. In crypto, the administration can get view-only keys to the wallets and can see everything that's going on real time, depending on whenever some transaction is taking place. They don't need the middlemen to tell them, because the whole idea of crypto is to have an open ledger where you can have private keys to either transact or to view. And so there's a whole infrastructure set up where admin and all that, it can be done very, very easily once the technology is in place. It's being put in place right now. And so once you start explaining that to investors, they start to understand that there might actually be some real benefits to the technology that can be used to make life simpler for investors.
Right. And when you allude to that, the transparency aspect, of course, we've seen it with Bitcoin from day one. And I talked a little bit about the metrics that we have in Bitcoin and in crypto that we don't have in the traditional sector because we don't have that level of transparency. And I think that the transparency of blockchain technology is what, when we see, when we see groups like BlackRock and Larry Fink talking about tokenization, part of what they're discussing in terms of the efficiency is that increased level of transparency. The fact that you and I are going to have a better idea of what's happening behind our investments, and not just every quarter, but literally up to the second, we're going to understand that. So we got less than 10 minutes left, Adil, and I wanted to see if there are any questions. So if anyone has questions, please go ahead and type them. Soren asked us about allocation, and I know, Adil, you spoke to this already about what your investors are thinking about. What is an appropriate allocation? So can you go back a little bit and address it directly? What do you think is kind of an appropriate allocation? And I can give my 2 Satoshis as well, being a formal financial advisor, what I talk to other advisors about, what is kind of an appropriate allocation to crypto, or how we discuss it. So I'll let you go ahead and go first.
So, if you think about crypto as a very risky asset, I would say it is still a risky asset. The price moves a lot. You should have some allocation, depending on what your risk tolerance and your wealth is. I mean, as a percentage of the portfolio, if you're young and you have a nice life ahead of you, working, what have you, put more into it, because this thing could make a huge difference. If your earning potential is, mostly in front of you and you have a little bit of savings, put 10% in crypto. It could, be like an amazing thing for you. But if you're like 80 years old and, about to retire and you barely have enough to, live for your 10, 15 years of your, maybe put a tiny bit, if nothing, maybe, tell your grandchildren to do it. So it really depends. But on average, I would say, I still think that 1% to 5% is a good range, like 5% for the aggressive people and 1% for the unaggressive people. And then, of course, the people who are involved in the industry. Like I have way more than that. Right. But that's because I'm in the industry. That's my career. So like, anyone who's a founder in the space or whatever will have like huge amounts in the space. But that's with any technology. Any entrepreneur has a lot more in the space. So those are special cases. But the special case people should not argue for others to have that much in it. So my range is 1% to 5%.
Okay, I'm kind of along those same lines. I tell advisors to talk to clients. For most of them, it's 1% to 5%. It's those people that are, have other assets in their portfolio, and this is going to be a piece of it, and they're going to take it out of whatever they're in, S&P or whatever they might be in, and put it into crypto. Yeah, it's probably 1% to 5%, like you said, based on their risk profile, based on their income, expenses, their liquidity needs. If they're younger, maybe a little bit more. If they're older, maybe a little bit less, although there is, like I could make the case that says, okay, if you're getting close to retirement, it might be a good time, if you believe in the investment thesis, to put a little bit into crypto, into Bitcoin, especially because as you get to retirement, your purchasing power of what you've saved up for retirement could likely go down if we see more and more inflation. As you know, if you're getting close to retirement, you haven't seen inflation very much in your life, or at least in your working life, and now you might see it in retirement. I could make a valid case for it, but for the most part, I tell advisors, look, probably 1 to 5%, unless they are, you know, kind of crypto natives, in which case people are going to come to you and have 95% of their portfolio in crypto, in which case it might be your job to, you know, take them out of it a little bit piece by piece so that they can live their life. But for most people, yeah, I would say 1 to 5%. Something interesting about the question that Soren made here is a financial advisor argued that the high net worth individual should have approximately 2%. The beautiful thing I think about Bitcoin crypto is those that are not high net worth, those that are not accredited investors, have the ability to invest and grow their assets. I think part of the issue and part of the problem is they've thought for years, this is how I'm going to go from, you know, being worth $10,000 to being worth 20 million. And they've ended up losing their 20,000 and going into debt, versus those that go, okay, I can get into this just like I could get into venture capital or private equity, except I'm not accredited. And so that, I think, is part of the beauty of Bitcoin and crypto, is those that are not accredited investors, those that are not already high net worth individuals, can learn about it, figure out how to safely allocate some of their assets and have an investment thesis behind it, and significantly potentially grow their assets and their wealth by understanding it from the beginning.
Yeah. And, you know, like the $20,000 savers or whatever, like, yes, if they put $20,000 into the wrong coin and it went to zero, that's one thing. But at any time during the last few cycles, if they had taken just $1,000 and put it into, you know, a few of these different things, they'd probably be way better off, right? So it's don't put all your eggs in one basket, even if it, or in you know, in the one risky asset. You have to do kind of a diversified thing. But you know, I would say, like, someone young starting out, if they were to, you know, stash away whatever, a tiny bit of their income every year, you know, put some in your retirement account or whatever, and put some into you know, blockchain and crypto assets. And I bet you people are doing that, because clearly the younger generation is more internet savvy and more crypto savvy and more open-minded to things having value in the digital domain. Like us old people, you know, we're just coming, oh my God, digital stuff has value. You know, the whole thing with meme coins and NFTs, that was the younger generation, right? And that's really all about internet culture being very different from the old real world culture. And, you know, I think it's going to prove to be a very enduring part of this digital ownership thing, where people are going to start believing in digital wealth, not just wealth representing real world assets that you can see and touch, but intangible stuff, which human beings always have. But this is now on the internet stuff that lives just there.
So with that, we'll wrap up here, and I'll say, look, if anyone's thinking about that 1 to 5% allocation and goes, look, I want the allocation, but I don't necessarily want to learn all this about it, that's where they go to someone like you. So tell us a little bit in the last minute or so, how do people get in touch with you and your fund?
Well, Samara Alpha Management has a website. We have contact information there. We have a lot of webinars. We have a lot of content. We are out there trying to tell people about it, teach people about it, and get them comfortable with experimenting with it. So, you know, we don't necessarily want people to invest with us, but we want people to start playing with the technology. We want them to buy some of these coins, open a wallet, whether it's Coinbase or whatever. You'll quickly find that, you know, once you become familiar with it, it becomes easier. And it's also very, very interesting. It's one of the strangest phenomena that has happened in the last few decades. The internet was a strange and interesting phenomena. The crypto is another strange and very interesting phenomena. It's leading to all kinds of new things. So please go out there and start playing with it. You know, it might seem like a toy, but believe me, it's actually real, and it's going to lead to real good business cases out there.
All right. And real quickly, from my perspective, what we do at Interaxis is we focus on helping financial advisors, financial professionals understand the technicals behind crypto, the investment theses, and how to make it a part of their practice. And the best way to get a hold of us, I'll put it in the chat, is check out our newsletter. We write this, several times a week, where we talk about not only what's happening in crypto, but how it affects the financial services industry, how it affects your practice, your portfolios. And, we have conversations like we're having right here. So thank you again, Adil. Thank you for everyone who tuned in, to Cohera, to Samara Alpha for putting this on. And we hope to see you all again in the next one of these that we have.
Thank you all.